All attendees are in listen-only mode.
Hello, and thank you for joining our webinar. My name is Amy Longmore, and I will be introducing your presenter today, Roy Johnson. Roy has over 40 years of experience encompassing corporate financial management, business consulting, entrepreneurship, education, investment banking, and mergers and acquisitions. Roy was the Director of Corporate Financial Planning for a Fortune 1000 company, the co-founder of 2 value-based strategy consulting firms, a principal in a management buyout, and the author of several articles and books on shareholder value. Please type any questions you may have during the webinar in the chat box to the right-hand side of your screen, and we will address them at the end of the webinar. We hope you enjoy the webinar. Roy, are you ready to begin?
I am, and thank you, Amy, and welcome everybody. We hope today we'll give you a good overview of private company valuation, how it's done on a practical basis. We will be covering quite a bit of material, so if any of you would like to have a follow-up on certain items that may be of particular interest or that we didn't cover, in enough depth for you, be happy to do that. You can get in touch with Amy and, we could maybe set something up. So for our purpose, we're going to look at a private company as a manufacturing, distribution, high-tech, healthcare, or business-to-business, which some people call B2B service company, generally with sales in excess of $3 million and likely to be purchased by another company or perhaps, a private equity group as opposed to an individual. And very importantly, containing some synergistic and or strategic value, which we'll discuss as we go through here for the buyer. So we're not going to be dealing with any kind of Main Street businesses, that are much smaller and are typically sold to individuals. A few learning goals that we'd like to hopefully impart to you today is, first of all, to distinguish between the public and the private marketplace. Excuse me. I've had a cough here for the last 3 weeks, so I hope you'll excuse me if I have a little bit of a coughing spell. Secondly, we want to understand the difference between value and price, characterize the major value worlds that exist within private financial markets, and then get into the basic formula that's used in private company type valuations. Look at a framework for small and mid-sized companies valuations, and then talked about some key principles and then a process for maximizing the price that's paid for a business that's for sale. So when we look at public versus private financial markets, there's 4 factors that are really different with each one. If we start with the public company marketplace, in which I spent a very substantial portion of my career, these are dominated by large companies that influence the market, the Dow 30, you've heard of those, the S&P 500, and so forth. And here, the focus is on after-tax profit and returns. There's a relatively narrow range of return requirements for the providers of capital. Basically, you start out with a government-type security, and then you move your way through corporate bonds and corporate preferred stocks, and then into corporate equities. And the range is in like the 2 to 10% range. And the market is very efficient. There's significant information. I mean, every day you got a report in all the financial journals that give a lot about stock price and the influencing factors in all the public companies. So it's a very, very efficient type market. Private market is quite a bit different. Here, mid-sized companies influence the marketplace. And the focus is almost entirely on pre-tax profit and returns. And one of the reasons for that is that tax strategies for individual business owners vary across the landscape. It's almost impossible to get any kind of effective tax rate for a private company that you can universally apply, let's say, to another company, even in the same industry. So the focus is on pre-tax here. And as we'll see in one of the ensuing charts, there's a very wide range of return requirements. So where the public marketplace usually goes from about 2 to 10% after tax, the pre-tax range goes from 5 to almost 30%. And we'll see that laid out here in a graph fairly shortly. And as opposed to the public marketplace, the private market is relatively inefficient. There's limited information. Private companies are typically rather secretive, about their financials. We subscribe and provide information to some private company databases that we use when we do comparable analyses and that sort of thing. But it's nothing at all like the public marketplace. So 4 major factors, 4 major differences between public and private financial markets. One thing, though, or a couple of things I should say that are similar, is that the value of an income or a cash flow stream really depends on who the investor is, whether you're holding debt, whether you're a bank or some other kind of debt holder versus an equity shareholder and those in between. One universally accepted concept is that higher risk requires higher return and vice versa. And some of the influencing factors of risk are basically the same in both of these marketplaces, and you can see these laid out before you. What market do you participate in? How big are you? Do you have recurring, revenue or not? Do you get a lot of your business from 1 or 2 customers? And the whole issue of managed capability that sits beneath the owner. So these kind of factors are fairly similar from public to private marketplaces. One of the things we want to differentiate right up front is price versus value. Basically, price is a fact, whether it's an asking price or an actual sale price, whereas value is an opinion. It's really what somebody thinks a business is worth. And it's based on what they believe they're going to gain either now or perhaps at some point in the future. One of the other unique features of the private marketplace is that we have what we call value worlds or standards of value, and we'll get into that in a moment. So to get into these different worlds, and there are 3 of them, 3 major ones, we start out with liquidation value. Obviously, this is a place you don't want to be. This is for an unprofitable business, and unfortunately, if you're in the construction business, it tends to predominate here because with the link to the economic cycles, the ups and downs, a lot of construction companies sell or are valued based on their book value, what kind of equipment, machinery, and things of that do they have in the business. So it's kind of a book value or asset sale environment that construction companies exist in. Fair market value is the next standard here, the next world, if you will, and these are used for internal buy-sell agreements, employee stock ownership plans or ESOPs are governed legally by the fair market value that's established by the IRS, as are estate and gift tax situations. Then these fair market values are based on the financial statements that exist within the company. You are allowed to make a future forecast, and as I mentioned, you've got some regulations that apply here also. The last of the worlds, which is the one we are involved with the most when we're selling privately owned businesses, is called market value. And here's where we're trying to get into some synergistic and strategic opportunities. And we like to differentiate between these two. Synergistic, the way we look at it, is more about cost savings and efficiency, and strategic opportunities are typically about growth. And these kinds of opportunities are really based on the buyer perception, which really are going beyond the financials, what that particular buyer thinks he or she may be able to do with the business, and they're often hard to predict. So you got three value worlds: liquidation, fair market value, and then the market value. You get different approaches for estimating value in each one of these. The asset approach, you basically use a liquidation value. You kind of go to a marketplace and hopefully you get an orderly liquidation of the assets, and that typically generates whatever price you're going to get for that business. The fair market value is governed by something called the income approach. Essentially, that is a discounted cash approach that uses the current plus projected earnings, establish a discount rate, and discount those earnings and cash flows back to a present value. And that is essentially the basic ingredient of any fair market valuation. In terms of the market approach, here we get into what we call these synergistic and strategic opportunities. And this is really what a business can command in the marketplace. And these can vary all over the lot. There's no real rule that applies, because different buyers will see, the same business in a different light. Okay, let's delve into a little bit more about the fair market value standard here. Most internal transfers are going to be governed by this, either due to practicality or to IRS regulation. So Revenue Ruling 59-60 within the IRS code governs how you do a fair market valuation. Some of the key elements are that they assume that there's a hypothetical buyer and seller, and neither is under any compulsion at all to buy or sell. They have adequate knowledge of all the relevant facts, and very importantly, there are no synergies or strategic advantages that are allowed in a 59-60 fair market valuation. And typically it's an all-cash sale. And as I mentioned before, you must do these for any kind of gift and estate tax filings. You must do it for an ESOP valuation. And typically, if you're doing something like a management buyout, even though it's not legally required, from a practical point of view, the fair market value standard is going to apply here. As we move forward to the market value world, we get into a notion called the most probable selling price, MPSP. And this is the basis for most external transfers that exist. And this is the price that is paid for the assets that are going to be sold. And this price represents the total consideration that's most likely to be established between a buyer and a seller, with one or two major differences from the fair market value environment. In this world, we're trying to create a market, somewhat like a public market that's out there. And here, we want compulsion on the part of either the buyer or the seller. So whereas under the fair market standard, you're not allowed to have this kind of compulsion, here we want it. We want somebody to be excited about the deal. And then the second bold phrase here is that we certainly want the buyer to consider all of the potential financial, strategic, and non-financial benefits that are out there. So quite a different situation here, and essentially what we're trying to do when we sell a privately owned business, and anybody like us, any investment banker or M&A advisor is trying to do, is create a market that will simulate to some extent the public marketplace, where there'll be some excitement, there'll be some compulsion, and where people will look beyond the books and records of a business in terms of establishing a value for it. The purpose then of the most probable selling price is one that's being marketed for an external sale. And obviously, due to its very nature, you're not allowed to use it with gift and estates and that sort of thing. And it's just not practical for things like divorce and disputes and buy-sell agreements and those kind of things. which are more governed and fall within the purview of fair market value. Okay, next item we want to talk about a little bit is what we call enterprise versus equity value. The terms fair market value and the most probable selling price, they relate to what we call enterprise value or total market value. And we're throwing these titles and acronyms out there just to give you a flavor for what is out there in the marketplace, to get you some familiarity if you haven't come across this too much in terms of the terminology that's used. You know, valuation has its terminology just like everything else. So enterprise value, total market value, and market value of invested capital, they all mean the same thing. It's the value of the total business. And this encompasses all of the capital that is invested in the business. And then when you get down to the actual equity value, you know, what does the shareholder actually get out of this? This is equal to that total enterprise value minus any outstanding debt. So the shareholders get what's left over after the consideration of the debt is subtracted out of the total market value. And that same concept applies whether it's a public company or a private company, okay? And this distinction is relevant because when we're pricing deals, you know, for companies that are in the market, they are priced on the basis of this total enterprise value, okay? And then typically the seller will keep his or her cash and then will pay off all the debt. Probably 90% of all the deals that are done in the private marketplace are done on that basis. So again, equity value is essentially what's left for the owner. Now, we haven't gotten into taxes yet, so this is all pre-tax, and obviously the whole world of taxes is a completely separate world, not part of this little presentation today, but something that if you are selling your company, obviously you want to get your advice, your CPA, and any a tax lawyer that you might have. So that's enterprise versus equity value. So next thing we want to cover is the basic valuation formula that governs most pricing excuse me, of private company transactions. And EBITDA, which we'll define on the next slide, earnings before interest, taxes, depreciation, amortization, is the governing metric for most deals. EBITDA is essentially your pre-tax cash flow. We'll get into its calculation on the next slide. And the way most enterprise values, most fair market values are established is to take EBITDA times a risk-adjusted multiple. And we'll talk about how you get that risk-adjusted multiple shortly. So let's just say, for example, we've got a company that's doing $1 million in EBITDA, and the market multiple that's appropriate for this particular industry or this market that the company participates in is 5, and that would translate into a 20% cost of capital. So $1 million times 5 would be $5 million. So if the company was in essentially a steady state situation and not really growing too much, that would be the valuation that would be established. The notion about going to market with a company and trying to enter into this market value world is to then try to look at what synergistic and strategic opportunities might be out there. So again, you know, just to be really simple and keep this thing easy for the time being, we're going to assume here that a strategic and or synergistic buyer sees a $200,000 opportunity in EBITDA over and above what's on the books. So they will take that $200,000 and capitalize that or multiply it by 5 to come up with another $1 million of value. So in theory, this synergistic strategic buyer would ascribe a value of $6 million to the transaction that had a fair market value of $5 million. So if you understand this concept, without getting into a lot of details, you kind of understand the way this whole thing works. So you have a fair market value that's essentially based on the books and records of the company, and then you have a strategic and or synergistic buyer that may see some opportunities either through cost cutting or growth, and they ascribe an additional value, in our case $1 million here, to get to a higher valuation. And that's kind of in a very simple context how this valuation environment works. So obviously we're assuming a going concern business here, a profitable business, and the whole area of liquidation value is not relevant to this discussion. So let's talk about EBITDA then. It seems to be the governing metric in most of these valuation exercises. So what we're doing is we're getting what we call an adjusted or recast EBITDA. This is the key metric for private company value. It's earnings before interest, taxes, depreciation, and amortization. In essence, it's a pre-tax cash flow. For those of you who have, without a financial background, and may not have come across this too much, depreciation and amortization are non-cash expenses. Again, you can cover that a little bit more, I guess, with your CPA. But essentially, all of the other costs, salaries, cost of goods sold, those kind of things are basically cash expenses. But with depreciation and amortization, the CPAs make an entry on the books reflecting mostly either capital equipment or some kind of goodwill or other intangible asset. And so you need to add depreciation and amortization back to your reported operating income to get what's called the pre-tax cash flow. So to do this, we start out with the operating income, which is called EBIT, and that's earnings before interest and taxes. We add back this depreciation and amortization. And then we may look into some expenses that may be unique to this business. Typically, we'll start out with the owner's salary and his or her benefits, things like auto, pension, insurance, maybe country club, excessive travel, that kind of thing. Some businesses may have the spouse on the payroll who doesn't really do too much. Some owners own the property and charge an above market rent, let's say, on situations. So we would add that back. And then if there are non-recurring expenses, some one-time extraordinary kinds of things, losses, write-offs, we would look at that and write that back. Add that back, I should say. So that would give us an adjusted level of reported profit. And then being that we took the owner out, so let's say we had an owner who was making $300,000 a year, and it might cost $180,000 to hire somebody to replace him. We would add that back under the replacement manager category, okay? And again, we'd load him up with benefits and that sort of thing. And then we would also add back any non-recurring gains on asset sales and things of that nature. So that would get us to this adjusted or recast EBITDA. Alternatively, we could begin with the net income before the taxes and add the interest expense to what we have above. But at the end of the day, we want to look at any excess expenses that are in the business that a new buyer would not incur, and also then factor out below market type expenses that would have to be accounted for. In terms of synergistic value, again, as I mentioned, this is about efficiency. This is about optimizing costs and expenses, eliminating certain kinds of things from the P&L and that sort of thing, and perhaps achieving, some economies of scale. So synergy is about becoming more efficient. Strategic value is really about growing. Typically, strategic buyers have committed to a course of action and they have made a decision that they need to grow by acquisition. They've been through that make-buy kind of analysis internally, and they've come to a conclusion that they really need to buy their way into whatever it is they're pursuing. Could be a new manufacturing facility, could be a diversification of either their customer base or maybe their products. Vertical integration is often a reason for doing an acquisition, and just could be try to get more market share and or move into a new geographic area. So these are kinds of examples of strategic value drivers, and again, this is usually then translated into some type of desire or estimate of increased revenues. Next thing we want to talk about is the cost of capital. This is a very important concept. It's the basis for our risk-adjusted earnings multiples. And in the world of private finance, we've got four major participants. We have the banks, we have asset-based lenders. For larger deals, we have mezzanine investors, and then we have private equity groups, which also includes family office. And in terms of a strategic buyer, in terms of quantifying their cost of capital, they essentially fall into the private equity group. So each has a unique role, in financing business transaction, and each have their own return requirements. And this translates into a cost of capital, which we have on this slide here. So as I mentioned to you before, you got a fairly wide range of return requirements for these four major providers of capital. Banks, and again, these are deals that are in the $5 million range, maybe a little bit lower for very large deals, and for smaller deals, they're definitely higher. But let's just use this as a template to try to get a feel for what's out there in the marketplace. So banks are in there in the 5% range. Asset-based lenders are looking to get 8%. This is the coupon rate on any note that you might take with them. Mezzanine investors are an interesting group. They typically are only involved in deals that are over $5 million. And think of a mezzanine like you would in a mall. It's kind of a mezzanine level in between the ground floor and a higher level. So the mezzanine investor sits in between the lenders and the pure equity players, who are looking for, in this case, about 23%. And on smaller deals, they can go up as high as close to 30% in terms of their return requirements. The mezzanine player, again, is only for larger deals, and they typically take a combination of a high coupon rate loan, and then usually we get some kind of an equity kicker to boot. And obviously the private equity group, or the equity that a strategic or synergistic buyer is going to use, this is their own capital, and they're looking for these kind of returns typically in the 20 to 30% range. So then to get market multiples, all you do is to take 1 divided by this rate. So for example, on the high end, if we have the equity of either a private equity group or a strategic buyer, if they're looking for 23%, then they're going to play a multiple of 4.3, 1 divided by 0.23. Same thing here, a mezzanine investor would be looking to pay a multiple of 5.9, close to 6, 1 divided by 1.7. So this is how market multiples are derived. They don't just drop out of the sky. They're based on risk factors, and they're based on the participants or the providers of capital that provide the funding for these deals. So when we talk about risk, which is a key driver for the cost of capital and for the pricing of deals, these are some of the key ones that buyers perceive: loss of customers, decrease in margins, maybe some key people leaving, new competition, and these kinds of things. And certainly, last but not least, economic downturns. Some examples of value, and it's kind of like beauty, it's in the eyes of the beholder. These are just 3 situations that we've had at Touchstone within the last few years. We had a distributor that had a financial value of about 1.2. We sold it for $2 million. We had another distributor that EBITDA of a little over $2 million. We computed a financial value of $11 million, actually sold for a little over $15 million. And on the other side, we had a technology company with $1 million EBITDA that had a financial value of over 4, but struggling to receive offers of 3. So bottom line is you just don't know exactly what's going to be out there. Key valuation concept that applies to all markets is that basic value is cash flow divided by some risk-adjusted rate of return. The key points to take home here is that the higher the cash flow, the higher the value, and the lower the risk, the higher the value. So if you don't take home anything from cost of capital but this, you'll have succeeded, because this is a fundamental concept that is very important to understand. Higher cash flow in and of itself is going to equal higher value, and if you can lower the risk without doing anything else, you will also increase the value. And the synergistic strategic buyer, they will pay for this perceived higher cash flow and or lower risk. Some key valuations that apply to all the markets here, and I'm going to go through this quickly because I know we're approaching our end time here. You've got revenues, you've got your profit metrics, your gross profit, EBIT and EBITDA, and obviously invested capital. That is particularly important for distribution and manufacturing companies, manufacturing particularly if you have, plant and equipment on the balance sheet. So these are the 3 areas we typically look at in terms of delving into the financial. We look at the top line, the bottom line, and then the balance sheet, what kind of capital is needed to move the business forward. So when we get into a sell-side situation and we're trying to maximize or optimize the price, there's 3 key principles. Different buyers will pay different prices for the same business. The buyer who perceives the most opportunity should be in a position to pay the most for their business, but he will never, ever do it unless he's induced to do so. In other words, that buyer will never offer all the business if he can buy the business for less. So how do we try to get them the best offer? We market the business without a price. We place these buyers in competition with each other, and we give them just one chance to make their best offer. They get one bite of the apple. So that's our session for today. Just a little bit about ourselves. There's 3 areas we work in. We do exit planning for owners. This gets very personal, who have businesses with sales of 5 or more million. Most of what we do is selling businesses that range in value for 2 to 20 million, and for larger companies, we help them, with their acquisitions. So with that, I will turn it back to Amy, and she'll tell you about our next session.
Thank you, Roy, and thank you, attendees. You may register for our next webinar on our website, www.touchstoneadvisors.com, or watch for an email invitation. We hope you will join us again, and this concludes our session for today. Thanks again.